I'm Craig Popp with Accrue Wealth, and this is your third quarter 2024 market commentary. After delivering record performance through the first 6 months of the year, the market did not take a breather and continued its upward trend. After 31 record highs and a 15% return through June, the S&P 500 index added a 6% return and 12 more record highs during the third quarter. Behind the strong quarterly return is a bit of data to unpack, so let's start with September. Equities bucked the typical seasonal weakness in September. In 2024, the return for the S&P 500 during the month was 2.14% versus a 10-year average of negative 2.31%. The positive returns for September snapped a 4-year streak of negative returns. September also marked the 5th consecutive month of positive return for the year. The Fed's pivot to easing, lower interest rates, and positive earnings growth drove the S&P 500 to record highs. The index is up over 22% year to date, its best start since 1997. Perhaps more notable is the month of August, which brought a bit of whiplash for investors. Markets fell at the beginning of the month, caught in the ripples of an interest rate increase in Japan, disrupting a significant currency trading strategy. This led to a brief, intense global sell-off. In the US, the incident was aggravated by a weak jobs report, with unemployment rising from 4.1% to 4.3%, which I would note is still historically low. That said, the report introduced us to the SOM rule, a macroeconomic assessment which judges whether the economy is in recession based on unemployment rate increases. Markets quickly recovered as other economic data such as retail sales and the consumer price index were stronger and kept the narrative that a soft landing appears to be the most likely outcome for the economy. Election news dominated headlines through July and culminated in President Joe Biden declining to seek a second term, instead endorsing Vice President Kamala Harris as the Democratic Party's candidate. What investors may have missed was a subtle shift in market leadership. Defensive, interest-sensitive sectors like utilities, real estate, and healthcare started to lead, while tech-related sectors lagged. For the quarter, all sectors, aside from energy, posted positive return. Tech underperformed the S&P 500 by its widest margin since the second quarter of 2016, clocking in at a 4.3% relative margin, while utilities and real estate soared up 19% and 17%, respectively. In fixed income land, the Fed officially kicked off its easing cycle after a 14-month pause, cutting the Fed funds rate by 50 basis points to a new target rate of 4.75% to 5%. The Fed's latest projections signal 50 basis points of additional cuts in 2024, along with 100 basis points of cuts in 2025. As a reminder, 100 basis points is equal to 1%. Intermediate and long-term Treasury yields ultimately rose following the cut, steepening the yield curve. As expected, short-term yields fell in the lead-up to the rate cut and in the days following. The 1-year yield has fallen 73 basis points since the beginning of August, while the 10-year yield is down by just 21 basis points. The Bloomberg US Aggregate Bond Index returned 5.2% for the quarter, rallying for the third time in the last 4 quarters. Performance was broad-based as the decline in yields and strength in credit-related sectors boosted returns. Given the risk-on environment, High yield bonds were also positive, returning 5.3%. This marked the 8th straight quarter of positive return for the high yield index, tying the longest streak since 2017. In my opinion, bonds have resumed their traditional role in a portfolio context, providing a stable source of reasonable income and an adequate hedge against equity risk. While yields have moved lower in anticipation of the Fed's easing cycle, interest rates remain above their 20-year average, providing a stable source of income in the months ahead. To conclude, I want to revisit the previous chart. However, I've added a data series that denotes the change in yield of the 10-year U.S. Treasury during each quarter. As mentioned in the past, bond prices rise when yields fall, and vice versa. We measure this change using a concept called duration. It appears we are entering a falling rate regime as the Fed has telegraphed several rate cuts over the next 2 years. Bonds can be attractive during this environment because investors earn return from the coupon and from price change. We can witness this concept during the fourth quarter of 2023 and the most recent quarter. Bonds are back. Thank you for your trust in us. Contact me if you have any questions.